are a safe way to play the market versus individual stocks. So we have a candidate-friendly trade for you here before the opening bell with the editor of ETFtrends.com, and that would be Tom Lydon. Good to see you, Tom.
Great seeing you.
You know, with the few minutes we have, the idea is if Hillary Clinton wins, that's being looked upon as the most likely outcome, not necessarily the definite outcome, but the most likely. What does that mean as an investor? How do you look at an ETF? What's some advice?
Well, she's a big fan of Obamacare. I think we're going to continue to see more of that, pushing the Obamacare more. It's great for generic drugs. So there's actually a Market Vectors generic drug ETF out there that's really been gaining steam as we've seen more steam with her campaign. In addition, Mexico has not been favorable towards Trump, but when she's done better in recent debates lately, we've seen Mexico peso increase, and also EWW, which is the Mexico ETF, the iShares Mexico ETF. On the contrary side, if Trump happens to win,
yes,
it's great for aerospace and defense. ITA is the iShares Aerospace and Defense Industry ETF. And then finally, banks with less regulation, especially he's not a big fan of Dodd-Frank. We're going to see probably banks do much better as well.
I think
if
a lot
either
of it, though,
candidate you're not a fan of, there's a new ETF that's out today, the Spirits and Whiskey ETF, WSKY.
There you go.
So you can drown your sorrows.
WSKY. You know, I was going to, you know, it's interesting because we do this story every 4 years, not necessarily with ETFs, but with markets in general. But how much does it matter? Or are you looking maybe for political sake at least at the House and the Senate, that if it all were to go to one side, then you have a different market, right?
Well, that's it. I mean, that's where a lot of the power is, and if something's going to happen, it's going to happen in the House and the Senate. Most feel that we're not going to see a heck of a lot of change right now, but again, fingers crossed. And for most investors, ETFs have been a lot more than these trendy areas that we've just talked about. A lot of it has been low cost. We're up to $2.4 trillion, and a lot of it's been going into core investment areas like domestic equities and like fixed income. However, we're going to have to watch and see what the Fed does, because we've had 30 years of declining rates.
We were talking about it earlier. Obviously, there's a bet now whether or not they'll raise rates in December after today's Fed minutes. But that being, you know, putting that aside for a moment, they will raise rates. Rates will go up from here. So how do you play that?
Well, that's it. So you have to be shorter on duration, no 20 and 30-year treasuries, and you have to look outside the U.S. Some areas like emerging market debt is completely in a great situation from a value standpoint, but average investors don't look to emerging markets as something that's safe. It's a great way to diversify.
It is safe in your view, though.
Well, it is compared to long-term treasuries at this point, hands down, but the average investor has to get through the educational aspect of that in order to diversify, to enhance yield, and look for areas where you can have some appreciation as well, as emerging markets this year have bounced back tremendously.
Okay, now before we're going to wrap it up here in a second, and we're still watching that Donald Trump rally in Florida, and we'll wait in the next hour. They should have coverage, I would think, of Hillary Clinton's event. Are you betting then, Tom, just from an investment point of view on one outcome or another, the Hillary Clinton win, for example? You're kind of pricing it into your mind real quick before we get the closing bell here?
Well, I think right now it's already baked in to the markets that we're going to have some unsettled candidate in place because of the lack of popularity, for sure. As you pointed out earlier, the House and the Senate really will rule the day. The key is, I think, is we look at the economy and see what's going on, and most importantly, what the Fed's doing as we close the bell.
On that note, well done, Tom. We're going to look at the markets.